Welcome to our YouTube live, and we have an hour together. So welcome, and this isn't a monetary policy meeting response, which always makes a nice difference to the usual thing that's been going on over the last week. But this is your opportunity to ask a question about anything you'd like. I've also got a bit of news, so good news, of course, and this is to do with our podcast, Many Happy Returns. Now, we finally got round to reducing, to uploading it to YouTube. We had to check out various stuff, but anyway, it's now there. So if you want to have a listen, please do. And I'll tell you what's quite odd is effectively you have to start up a new channel. So let me just show you what it looks like. But what's odd is we've gone back to 0. So it reminds me of when I first started my YouTube channel and there were no views, no subscribers. And at the moment we've got 11 subscribers, but all 130 podcasts are up there. So do have a listen, and you can always subscribe on YouTube if that's how you like to get your podcast. You can get it on Spotify or Apple Podcasts or wherever you get your podcast. But this just allows us to turn up on search, I think. But yeah, anyway, we're there now, which is good news. It took a long time to sort it out, I'm afraid. And yeah, overall, markets bounced back today, which is good news. So the S&P, I saw, had its best day since, when was it? Since 2020, January 2023. So not far ago, not long ago. But still, it's nice to see markets bouncing back a bit. I think markets did overreact to what happened with the US jobs report. You know, the carry trade from Japan, obviously that affected things too. But I think a lot of that will not be long lasting in terms of its effects. So I think there will be a wobble. I don't think this is going to be a long lasting drawdown. But the US is expensive, and it's still expensive after that sell off. So maybe it's a healthy thing that stocks went down a bit. And I think they could have gone down a bit more. But, you know, that's just the way markets work, I guess. People are still conditioned to think that US markets will always go up, I think. So, yeah, let me say, like and subscribe. Please do like this video and subscribe, even if you're watching it in replay. And, yeah, do subscribe to Many Happy Returns, our podcast, and you'll find that on YouTube now. So if you do want to find it, you go to youtube.com at Many Happy Returns Podcast. At Many Happy Returns Podcast. And we've also got a weekly newsletter, so we try to keep that entertaining and informative. For example, recently we covered what happened with the Bank of England, but also the Bank of Japan. And yeah, we made a joke at our own expense. Yep, the Fed decided to do nothing. I managed to produce a compelling 40-minute live stream. And yeah, I can spend hours analysing Jerome Powell's nuanced comments, subtle hints, and snazzy neckties. Yeah, but anyways, talking about the inferences that you can draw from monetary policy and the consequences for markets. So, yeah, do have a look at our weekly market roundup. If you want to find that, go to our website, PensionCraft.com and /newsletter. PensionCraft.com/newsletter. And you can sign up for that. It's free, so best price of all. Right, so questions. Let's get started. Now, if you do a super chat, obviously we push you to the front of the queue. If you're one of our supporters on YouTube and you ask a question, again, we'll push you to the front of the queue. And we'd appreciate it if you do a super chat, because obviously it helps us financially. So that would be great if you could do that. But we will answer questions even if you don't do that, so don't panic. But I can't guarantee we'll get to your question. I see David Sharman's just signed up for to support us on YouTube. Thank you, David. And let's have a look at a question. Okay. First question from Khalifa31. What's your opinion on Nvidia stock? Is it expensive if we consider metrics like price to earnings ratio? It is expensive, but they don't have any supply-demand issues. Their margins are huge. Their AI chips market share is high. Yeah, that's all true. But obviously, I mean, if you're familiar with the stock, you know the counter arguments to those statements. I think the problem is that it's been growing so quickly, and I think at a certain point it's going to stop growing so quickly. It's simply a question of when, and a question of, has it saturated its market? So personally, I think there are so many competitors trying to edge into this AI chip market that eventually it's going to, probably sooner, I think, run into problems, which is that other people are undercutting it. And if it does have other competitors in the space, which it already does, of course, then I think that's going to be a problem for them, particularly if their margins are so high. Other companies can undercut them quite easily. And it's not the case that this is an unattainable technology. That's just not true. They do have an advantage in terms of having made high-end graphics cards, which require these chips, and then using, they've got their own software, which is also part of their offering, which is very good. People like to use it. It's become an industry standard for parallel computing and large language models. But eventually there's going to be an alternative. There's already an open source alternative, for example. So, very high expectations for a long period of time, and eventually it's going to become a problem. Let's see if we can find Nvidia earnings history, and then we can have a look at how quickly they've been growing. Simply to see, how rapid it's been, and just to see whether it is feasible that it's sustainable. Here we go. So this is Yahoo Finance. And when was this article? This was February 2024. So it's not that recent, but it's quite recent. So here's the incredible earnings growth. And so it's got revenue and it's got net income and EBITDA. So you can see the revenue growth has just been incredible. Their margins are huge, as you can see. Revenue's a lot bigger than revenue's not a lot bigger than EBITDA. So cost of sales isn't huge. So I think, it's just a question of whether it can carry on growing at these rates. And at a certain point, it's going to saturate the market. A lot of the hype in AI, I think, is already starting to subside. And I think that was part of the reason why the S&P started to tail off. And so did Nvidia. So if we look at Nvidia's share price, for example, that was one of the big casualties in this sell-off. And of course it's bounced back, but not by a lot. So it peaked at $140 a share. And now we're looking at 105 currently. So pretty big pullback. And if we look at the financials and look at the income and how it's changing over time, you can see the EBIT's just gone sky high. But at a certain point, it's not going to be sustainable. So this is why I think if a stock is buoyed up by euphoria and it's got incredibly high expectations in terms of its earnings growth, then ultimately there's going to come a point where it disappoints. And I can't believe that we're that far off it. Let me see if I can find the historic price to earnings ratio for it, because that could be interesting. I think Yardeni has it for the Magnificent Seven, of which it might be included now. I don't know. Megacap 8, perhaps it's included. No, it wasn't originally, was it? No. Oh, pity. Yeah. I haven't got the historic price to earnings, but all I wanted to show was that its valuation is very high, even relative to that forecast earnings, which prices in optimism and information about how quickly its earnings are growing. So that's the problem. But when you overpay for something, usually you underperform following that. That would be my worry. But is it a good stock? Yeah. It's very profitable. It's got a very high margin. It's got an incredible business. It's got incredible products. But my worry is about sustainability. And certainly, I don't own it. I should point that out. Tim M says, you have a lot of videos of lump sum versus cost averaging, and you did the latter recently. Based on all of it, if you got £1 million extra today to invest in markets, when and how would you invest it, and ideally in what? So I think if I had £1 million, I'd probably put it into higher risk investments, simply because it would be money that I wouldn't touch probably for some time. I have a pension already. I have ISAs already. We never have enough, of course. I certainly don't have enough for a comfortable retirement, put it that way. A very comfortable retirement. But I think I'd probably put it into slightly higher risk stuff, because it would definitely go into my long-term bucket. So probably more into global equity, definitely. And probably the same fund I've currently got, which is VHVG. Now, I wouldn't be able to park it within a general investment. I'd have to put it in a general investment account. I couldn't get it into my SIP, obviously. That sum of money, which means that it would generate capital gains, which I'd have to pay tax on, and that would be a problem. I'd try and put as much as I could into my ISA, obviously. But yeah, I guess I would drip feed at the moment, because I think markets are slightly choppy at the moment, and I think valuations are relatively high in the US, even after this sell-off. So if we have a quick look at that, the forward price to earnings multiple for the S&P I do have. So this is one of our trackers. And what this shows you is the S&P. So currently, or at least when I made this graph, it was 5,200. And that was above the 5-year average price to earnings multiple, because the forecast earnings are $263. The average 5-year price to earnings multiple, forward price to earnings multiple, is 19.3 times. So that would give us 50.78 for the S&P, and we're above that. And we're above the 10-year by 14%. And we're above the 60-year, that's 24% below where we were on yesterday's close. So this is what worries me, that even after the sell-off, the US is looking expensive. And that means the support of valuation is just not there. And that means that if there is something scary that happens, shocking news from the Fed, shocking news from the economic data, in this case, the employment report, then there isn't a support to keep markets inflated. And the AI narrative, I think, is starting to subside. And until a new narrative comes along, there's nothing to buoy up these stocks to ever higher price to earnings multiples. So really you're dependent on earnings growth being very strong and continuing to be very strong. And it is forecast to be. It's still double-digit forecast profits over the next couple of years. But at a certain point, presumably, that's going to go back to a more normal rate of growth, which would be around 6%, 7% rate of earnings growth. Or perhaps it'll even start disappointing. So that's my worry. Things do look expensive, in the US at least. Okay. So what I'd probably do is I'd put it into VHVG, what I usually do. If it is capital gains that it's going to be generating, maybe put some of it into, kind of barbell distribution, maybe use it to generate income later on, like just before I retire. But certainly for now, I'm way off retirement. I just don't want to retire because I enjoy what I do. So yeah, a lot of equity, probably that global equity fund, maybe something more speculative, some of the fund portfolio. I'd expand my fund portfolio in proportion. So 10% of it, 100,000, would go into my fund portfolio, and I'd have even more fun. I'd lose even more money. So that's probably what I'd do with it. But of course, if you do make losses, then in a general investment account, you can write it off against future gains. So that would be a potential benefit, I guess. But that's probably what I do. And I would drip feed probably as well because of the choppiness of markets. 12-month drip feed into VHVG and buy some of the stuff which I like, which is in my fund portfolio. Scottish Mortgage fell again recently, so maybe buy some more of that and keep an eye out for other things which become cheap, which then I'd buy for a capital gain. But that's what I'd probably do. Oh, I see we've got some super chats. Thank you. First one is from Simon Scott, who says, thank you, Simon. He says, when are money market fund rates likely to fall? And is it now time to switch into longer term gilt as an alternative? That's a good question. And let's pull up one of those money market funds. And I'll plot it. Right. So here it is in SharePad. So this one's CSH2, which is the Lixor Smart Cash Fund. It's an accumulation money market fund. If we plot another one, so there are lots of these in the UK. UK money market funds. UK money market funds. You'll see that the returns are very similar. So this is a BlackRock Cash D money market fund. And I'll plot that versus that CSH2 fund, just so you can see how similar the returns are. Here we go. So very similar indeed. Not identical, but very similar. And the gradient tells you the rate of return. Now, since the Bank of England cut the bank rate by 25 basis points from 5.25 down to 5, the slope here will have reduced, my guess is, because this thing, they often track SONIA. So let's look up SONIA, and that should have fallen. We have to use an incognito window because the Bank of England is incompetent when it comes to websites. And hopefully this is going to work. Here we go. So the Sterling Overnight Index Average is the benchmark rate which many of these money market funds track. And this is it. So SONIA. And we'll look at the chart. So it was 5.25 or 5.2, I think. Let's see what it is now. I'm guessing it's going to be something like 5 or a little bit less. Here we go. So it was 5.2, it's now 4.95. So yeah, so less by 25 basis points, unsurprisingly. So this thing will track bank rate down. But remember what the Bank of England said, which is that they're not going to do it fast. They're going to be cautious, and probably they're going to wait a while and see what happens. Now they've cut it to 4.95. So, I think it's going to be a long time to come down a lot. So you've got plenty of time to rotate out into fixed income funds. So now let's take a look. Bear that in mind, right? So remember that 4.95. Now we're going to look at the yield curve. And again, we can use one of the trackers from PensionCraft for that. So obviously, if you have our premium website membership on PensionCraft.com, you get access to these. So it's the macro one, macroeconomic. Just maximize that. And we'll pull up the yield curve. So 4.95 was the money market fund. You can see the highest yielding gilt is currently yielding, or as of yesterday's close, it was a total of, has it got the yield? Yeah, 4.71%. So that's the highest returning gilt. And you can see that one is effectively the kind of thing that a money market fund would buy, because its maturity is almost zero. It's 0.1 years because that's going to mature very soon. It's going to mature on the 7th of September. So that's got about a month to run. And so that's almost matured. It's got this pull to par effect. And if you annualize the yield, it'll give you 4.71. The next highest is 4.51, and it falls off very rapidly as you go to about 5 years maturity. Then it reaches the bottom of the dip and it increases again up to 20 years. You get 4.5%. So I don't think that's very competitive. And at this point, I'd still be in a money market fund because nothing catastrophic is going to happen. It's just that the income you receive on the money market fund will just gradually fall as the Bank of England cuts. And then presumably the short end here will fall as well. And at a certain point, the curve will start to have a positive term premium so that if you lock in a 1 year, 2 year rate, you'll get more than you do for a money market fund. However, that's not the case yet. And I think we've got quite a long way to go before it becomes attractive to lock in a rate with a gilt. Now, there are all sorts of accidents that could happen in the gilt market. And there's already talk about changing the fiscal rules so that Labour's got enough money to spend on growth. So if that happens, maybe markets will balk at the idea and push down gilt prices and push up yields and give us a better opportunity to lock in a better yield. But for now, I just don't see it. I don't see the benefit of switching. So, I'm not going to do that. And I've still got CSH2 is the one I'm using. But any of those accumulation money market funds, of which there are many, any of them will do. They give very similar returns and they track, their benchmark is that SONIA rate. Right, and second question, also a super chat. Thank you, Rajasilan Ganeswaran. I thought I said that well. He says, will you buy Evil PLTR, the next consulting firm? Well, I don't buy single stocks. And I know the narrative around Palantir, that its technology is being used for used by Israel in its war against Hamas and in the Gaza Strip. But would I buy the stock? I do have some scruples actually when it comes to buying stocks. Personally, I'd probably keep away from it. I don't usually buy single stocks anyway, but that's one I'd probably avoid. I don't think I'd find it palatable. But how about the stock itself? Is it an interesting stock? Let's have a look at the price to earnings multiple. It doesn't just use it for military technology, for example. It also powers things like the National Health Service in the UK. So, it's used for many different things where you need to analyse large quantities of data. And military applications are obviously quite profitable, so that's just part of its business. But let's have a look at Palantir's share price. Actually, let's have a look on Stockopedia. That's always a good summary of what a stock's doing and how well it's looking in fundamentals. Here we go. So what Stockopedia's got, which is quite useful, is this 3-number summary. Well, actually a 1-number summary, which is the stock rank. If that's 100, it's a very good stock within its universe. And in this case, let's put it into United States. You can see that the stock rank is 69, so that's almost the 70th percentile, so it's pretty good, better than the average, well above the average. Quality, so its balance sheet strength, its earnings strength, all of that stuff is pretty good. Value, 2. So that tells me that people have already bought into the story and I'm very late to the game. And immediately that tells me that probably a lot of the returns have already been snatched by somebody else. That's not the kind of thing I'd look for. What I'd prefer to do is to go for something which has a better stock rank. And it's interesting, this doesn't do particularly well for the S&P 500, this stock rank It's the one market, I think, where it just doesn't work in the back test very well at all. For almost any other market it does if you break it down by country. For the UK it does very well indeed. So if we switch to UK, it's much better. But anyway, that's my issue with Palantir, which is the valuation. It's very expensive. And yeah, that's probably, even if I would consider buying it, that's probably why I wouldn't. But there we go. The thing is, this isn't a political YouTube channel, so people don't want my view of politics. But yeah, you did ask, so that's my answer. The next question is from Steve Kitch, who says, also super chat, thank you, Steve. Recently transferred ISA to new provider, now sat in cash and avoided the recent dip. So I bet you're feeling pretty smug. Earning 5.2% interest, great. Would you, actually probably 5, right? Because the Bank of England cut. Would you go into a global fund now, wait for things to stabilise, or drip feed it over time? Yeah, I mean, if I've got a lump sum, then I'd probably drip feed for the reasons I said, which is that we are entering this kind of transition period in terms of monetary policy. So effectively, if I was to summarise the last 4 years, we switched the economy off, we switched it back on again. We had supply bottlenecks. We had a huge inflation spike as people went back into the economy and did stuff again. And there were huge demand increases while the supply was constrained. It pushed up prices. We got the energy shock. And then that kind of fed through second round effects into other parts of inflation baskets across the world. Now what we're seeing is a desynchronization of cycles around the world. They were synchronized by the pandemic, now they're desynchronized. One case in point, of course, being Japan. And we saw what happened when the Bank of Japan finally decided to raise interest rates to just 0.25%. The whole reversal of the carry trade spilled volatility into other markets. So I think during these transition periods, you have accidents like that. Pockets of leverage, financial scandals that become revealed by a change in macro. All of these things happen during these transitions. So that's my worry, that we're going to get more of these accidents. Lay on top of that the geopolitical risk that we've got at the moment in the Middle East, and also the conflict between China and America, and a US election coming up in November that could really change the face of politics globally. Then, I think you've got a lot of tail risks. But it's always the case that you've got some tail risks. I just think at the moment, we are in this macro transition period in terms of rates, with US valuations very high. I don't think that's ever good. That does seem like a kind of choppy backdrop where volatility is going to be higher. So yeah, I'd drip feed, and if there was a crash, I'd accelerate the drip feed. I'd never go back. I'd never sell. It's always buying. So the idea is you get fully invested according to the portfolio target you've got. It doesn't have to be 100% equity, it could be 60-40, 50-50, whatever you want. But you reach that allocation after a certain period of time, usually a year. And my previous drip feed was 2 years, that was too long. It's very boring. Nothing really happened. So yeah, that's what I'd do. A 1 year drip feed, probably. And just guarantee, have some kind of threshold for the price to earnings multiple. So if it falls to, I don't know, currently we're at over 20 times forward earnings. If it falls to the 5-year average, you accelerate a bit. If it falls to the 10-year average, you accelerate a lot. That's, some kind of heuristic which you stick to, and only ever accelerate, don't step back, because what you want is to be fully allocated by the end of the period. Because it's really tempting when things are falling, prices are falling, you just think, well, if I delay this by just a day, I can buy it at a cheaper price. But that's the road to perdition. You don't want to do that. So that's what I do. Next question again from Roger Seelan Ganaswaran. He says, how do you restrain from FOMO? Okay. Well, I've got FOMO, when I see that something's doing incredibly well, like Laura. Laura's got this stock, Nvidia, and it did incredibly well. And she's still up about 100%. And yeah, I had FOMO that it wasn't in my fund portfolio, but, do I feel bad about it? Not really. I've got reasonable returns in my fund portfolio as well now. So really, it's a matter of having realistic expectations of what you can achieve. And, I know this problem, which is when you do get FOMO, you're the last person to enter a trade and then you get burnt. So, for example, with cryptocurrency, by the time it's all over the media and you're really getting that FOMO badly, usually it's towards the end of one of these hugely volatile, huge rally, huge crash cycles that we get with crypto. To take an extreme example, meme stocks, that was another example where if you were late to the game, you could have got wiped out, and you probably did. But people don't talk about that. You only hear from the people who've done incredibly well. So that's why I think FOMO, I think it's just repeated learning by making mistakes. I've been burnt so many times that I finally learned. It's kind of like hangovers, right? You kind of always think, oh, I'll never do this again. And I've reached a certain point now where I don't do it again. I do drink, of course, but, not a lot. And, I just hate the hangovers, the near-death hangovers, which I had as a young man, which, were awful. So it's a little bit like that. You only hit your head against a brick wall so many times, hopefully. So it's just bitter experience, really, Rajasila, I guess. Next question. And I don't know how to pronounce this. It's Doctor, and then 4 zeros, and then 2008. So thank you for the super chat. I'll call you Doctor 2008. And you say, are you aware of a new global tracker ETF called Acqui, reduced to 0.12%, previously 0.4%? Which would go for between this and which would you go for between this and PRIW? So let's have a look at that, because funnily enough, it was mentioned on our chat forum by our members. So let me just pull up the chat. And yeah, here we go. So somebody says, it's a very active member of our community, an incredibly knowledgeable person. That's true of a lot of our community. And they say the kid for Spider Acqui, and they give the ISIN code, bless them, which I can now use, has updated to a total expense ratio of 0.12%. So I think this ETF belongs at the top of the global equity cheapest fund tracker alongside HSBC. So for members, we keep a database of the cheapest funds within each category. Developed market trackers, global trackers, this is for stocks, global bond funds, and so on. Money market funds, many categories, commodity funds. And yeah, so anyway, I haven't got around to adding it to the list, but let's Google it and have a look at the fund. Because the one thing let's have a look at it and just see where it's domiciled, for example. So this is a State Street fund from Spider. Share screen, here we go. And let me move myself over there, full screen. So what would I look at? Firstly, it's already pretty big. So 2.2 billion in assets under management. It's an accumulation fund, so that instantly makes me like it. It's created by sampling, so it doesn't buy all of the stocks in MSCI All Country World Index. Remember, this is a DM and EM fund. And yeah, the expense ratio now, 0.12. Previously, it was ridiculously high, as if they hadn't realised Vanguard now exists in the UK. Well, they finally realised, and they've been vanguarded, which is great for us. The thing I'm looking for is their domicile. So fund domicile Ireland. Why do I like that? Because of withholding tax. So if you hold a Luxembourg domiciled ETF, the withholding tax is 30% instead of 15%, and that can accumulate quite a big difference in dividend reinvested long term. So if you can avoid withholding tax, it's a good thing to do it. If it was a synthetic fund, you wouldn't have any withholding tax at all, which would be even more efficient. But this one, it's physical, it buys stocks, but it doesn't buy all the stocks. So the other thing I'd look for would be the tracking error to see how closely it tracks MSCI Acqui. And I'm guessing that's also listed here. Just ETFs are very good for that kind of thing. The other thing I check for is whether there's a sterling listing. There is. So there are two versions of the fund. One of them is in sterling, so that's this one, ticker ACWI. The one in dollars is ACWD. I'd avoid that because what I don't want to do is convert pounds to dollars on my exchanges, on my brokerage platforms, on my investment platforms, because for many of them I pay a fee to do that. So if it's already in sterling, then fine. State Street can convert it to dollars much more cheaply than I can. So I'd go for this version of it, Acqui. So I think this definitely has a place at the top table, yeah. And I'm going to add it to our tracker. In fact, I'll probably do that tonight. It's just a spreadsheet which I have to update, and then it feeds through to the website. Yeah, so I'll add that tonight. That was on my to-do list. But I do like that fund, and it is global. In fact, you know, I've got FWRG, but you asked about PRIW, and the problem with that one is if we look at the domicile, I believe it's in Luxembourg. Yeah. So the fee on that's very low. It's only 0.05. But once you factor in the withholding tax, it turns out, I think, from memory, that the fee is effectively 0.17 or something like that. So the other one's probably better if you factor in this domicile problem. And this one is full replication, yeah, so it's not synthetic, so you're going to have to pay that withholding tax. So I think that's the problem with PRIW. I mean, on the face of it, the fee's very low, but you have to consider that withholding tax. So that's exciting. You know, you don't usually get one of these bread and butter ETFs with such a competitive fee entering the market. The other one that a lot of the pension crafters use is not an ETF, so it's not on Just ETF. It's the HSBC Global Equity Index Fund. Let's see if I can find it. It's not the Islamic one. Islamic Global. Maybe it's All World. Yeah, I think this is the one. Yeah, this is it. Ah, missed it. Let's look on Hargreaves. That was the right one. It's Class C, I remember that. And it's an accumulation fund. So this one, the fee also, it's annoying because this one wobbles between 0.12 and 0.13%. And all the time on our chat channels, someone's saying, Ramin, it's gone up to 0.13. And then a week later, it's gone down to 0.12. So I'm always having to change a spreadsheet. So currently, according to this, 0.12, although I think it's gone up to 0.13 again. But this one is another I'd consider. It's accumulation. I think it's, yeah, it's a fund, not an ETF. Is it an ETF? No, I think it's an open-ended investment company. So on Hargreaves, it's going to be quite expensive to hold. An ETF is much cheaper. But still, yeah, this is one many pension crafters have because it's cheap. But yeah, definitely we'll add that to the list. Next question. Oh, no. Laura has a chat. She says, I'm going to send Teddy up. Otherwise, he gets upset that he's missing out. So, just to tell the AI dog tricks now. Because it's brilliant. We've got the AI now putting the chapters into these live streams. So the poor souls who watch it and replay don't have to wade through everything. You can just get the thing you're interested in. You didn't waste any time, mate, did you? No. Drink first. Oh, I dropped it. Oh. Right, you're going to stand? Very good. Should we tell the people about your personal problem, Ted? You've got a bit of an issue. He's got fleas. Yeah, Laura's downstairs, mate. All right? You go and get the billet on. We'll just talk amongst ourselves up here. Go on. Go, go, go. Go and see Laura. Go on. Go, go, go. Yeah, he's off. Yeah, he's got fleas. So we're taking him to the vet on Monday. Don't tell him. It's all right, mate. Just talking about you. Hope he didn't hear that. He doesn't like that word. Yeah. Anyway, so we're going to sort him out on Monday. So he's been scratching a lot. Yeah, poor thing. Anyway, next question is from Dr. 2008 again, another super chat. Thank you. What about WebN? Okay, let's have a look at that. WebN. And I assume it's a fund. Oh no. It seems to be a company. Incubation hub for fintech. Does that sound right? We unlock Web3 for institutional finance. So that was the previous narrative about tech stocks that was pushing up prices. Web 3.0. So it's an incubation hub. Not one I'm familiar with. Can you invest in it? Is it a publicly listed company? Let's have a look. WebN. Nope, doesn't seem to be. So I'm not really familiar with that. Sorry. So I can't comment on it. Or perhaps it's a fund. Anyway, if it is a fund, just stick it onto chat and Laura will pass it on to me. And yeah, so let's just go back to Many Happy Returns. Why not subscribe while we're online? That would be great. Would that be offensive to you, the audience, if I asked you to subscribe? So just go to PensionCraft. No, sorry, what am I talking about? YouTube.com/ at Many Happy Returns podcast. So that's the URL. YouTube.com/ at Many Happy Returns podcast. If you could subscribe, that would be great. We've currently only got 11 subscribers, and yeah, it's a good place to listen to the podcasts. Now, we don't do video yet. I should have a chat with Michael about that, about moving it to a video format. I think that would be quite cool. But it's a lot more work to edit. So, I'm not sure we've got the bandwidth to do that at the moment. But Michael's got his plate full at the moment with his family. Good news, not bad news. But, yeah, I don't think we're going to do that anytime soon. Okay, so somebody's saying it's on Just ETF. So let's have a look. Just ETF WebN. Oh, okay. Oh, I'm not familiar with this. How exciting. Always like a bit of new fund action. Here we go. So expense ratio 0.07, tick, accumulation, tick, full replication, I prefer synthetic. Domicile, Ireland, woohoo! And all country, so it's tracking the EM as well as developed. Yeah, I mean that ticks all the boxes too, and the fee's just 0.07. Well done, Amundi. Now, why won't you talk to me? They've been ghosting me. You know, I've been asking for an interview with the guys who run CSH2, the money market fund, but they don't even reply to my emails, which is just shockingly bad. You know, I mean, the thing is, I'm really into finance and I'm not going to give them a hard time. I'd just be really interested to learn about the fund and the fund managers and the mechanics of CSH2. It's for a boring fund, it's surprisingly interesting, I think. And, you know, squeezes out a lot of knowledge about finance and how to manage these funds, synthetic ones in particular, like CSH2, the collateral basket. There's all sorts of juicy stuff you could dig out of an interview about that. So, Mundi, if you're going to listen to this, please do a podcast with us. I would love to talk to you. But, yeah. So far they're ghosting me. But anyway, yeah, WebN, very good. So can you buy it? That's the other question. Let's have a look on Trading 212. WebN. Is it available? Was it an ETF? Yeah, it must be on if it's on just ETF. So I can't buy it by the look of it on Trading 212. Just log into my account. WebN. No, it's not there. Maybe it's because it's a new fund. So the inception date was quite recent, I think. Inception date. Yeah, listing date was 5th of June 2024. So it's only been around for a couple of months. So that's probably why it's not on all the platforms yet. But hey, that's really interesting. Thank you for sharing that. I do love a new fund. So I've got 2 to add to our list. They're like buses. They all come along at once. So thank you for suggesting that, Dr. 2008. I appreciate it. And the next person... Oh, that's the best handle ever. Pooping while standing. Oh, very good. Do you have a colleague? Waddle of shame? No? Okay, anyway, $2. I think the question is thoughts on WTI and UNG. So let's have a look at. So I guess WTI is an oil tracker, or it's West Texas Intermediate itself. So is there a crude oil ETF called WTI? Well, there are leverage ones I can find on ETFDB. These are the ones I'm talking about. So you've got a 3 times levered energy and 3 times inverse levered, so that's a great way to lose money. But I'm guessing WTI, you're referring to a tracker for energy. Let's have a look on Just ETF. Just ETF WTI. Oh yeah, here we go. Oh no, it's called CRUD. That's the name of the crude. But I guess you're talking about an oil tracker. And the other one was UNG, which I'm not familiar with. So United States Natural Gas Fund, UNG. Yeah, I mean, a lot of people bought into the natural gas story. Let's have a look at the price of it while I chat. So this is UNG, and this is just a one-day chart, so that's meaningless. Let's get the whole history. So you can see that for starters, these funds often have negative carry, commodity funds, because if you imagine the futures curve is upward sloping, which it is most of the time, then to maintain exposure, they have to sell the one which is expired, the futures contract which is expired, and buy the one which hasn't further up the curve. So you're constantly having to pay away that carry, the difference between the short and long end of the curve. Now there are various ways to minimize that carry cost. You can go further out on the curve where it's a bit flatter. You can dynamically change the strategy based on whether the curve's inverted or not. There are various tricks you can do, but let's have a look at a slightly shorter timescale, 5 years. Right, so you can see the spike in energy that we got in May to August of 2022. Now, the standard narrative was after it fell was that it would rise again because there'd be supply bottlenecks, because China, if it's a cold winter, will have huge demand for liquefied natural gas, as would Europe, and they'd compete with each other to get a reasonable price. And that would bid up the price of LNG. Now, what's actually happened is the price has collapsed. So obviously a lot of people lost money with that. So you've got two problems with this. The first is negative carry long term. So you can see that here. The second problem is that you've got to be good with your timing, and you've got to be right about the narrative. So, you know, if you're going to play with this, firstly, I wouldn't do it in large size. Do it just before winter's supply increase really kicks off, because there's always a chance that one winter there's going to be a supply squeeze, and there'll be some kind of geopolitical instability or a supply bottleneck or whatever, and that we'll get another squeeze and the price will go up. So, you know, winter is probably the time to do it, just before winter. So you buy in autumn. Buying in summer, maybe, you know, that's not such a good thing. But yeah, look, it's a speculative trade. Energy is always very unpredictable. It is volatile. So if you buy it at the bottom of the range and you're patient and you don't have negative carry, that can be an interesting thing to do. So, you know, I think that's one to watch in my fund portfolio. The other commodity I'm looking at actually at the moment is copper. Copper, here we go. This is the London one. Yeah, this is the Wisdom Tree Copper Fund. It's sterling denominated, and the copper price has been particularly weak recently. Maybe not on a long-term time scale, but you can see it's been plummeting since its high, which was in May. So I'm watching that quite carefully, because the growth story in China is still a bad one. So that's pushing down the price of copper. And, you know, if there is a supply bottleneck later on, which there was an interesting report that was done recently which suggested that the supply and demand would be most out of sync in 2025 because of the energy transition starting to heat up. And at the same time, supply would be squeezed or wouldn't be able to increase fast enough. So that'll push up the price of copper. So at a certain point, I think this narrative about, China's growth is awful, there's too much supply of copper and it's pushing down the price, will shift to, oh my goodness, look at all these wind farms we've got to build. Look at all these EVs, which use 4 times as much copper as every internal combustion engine car. Look at these energy grids that we're going to have to build to service that infrastructure. Well, all of that requires copper. So I think, you know, there could be a good story there. So, you know, if you've lost money with oil and gas, why not lose money with copper? You know, I'm being sarcastic, but, you know, this is all fun portfolio stuff, which is great fun, but you're not going to be able to time it probably, and you'll probably get the narrative wrong. So do it, but don't do it in large size, would be my advice. Because it's fun. You know, it is fun. Oh, someone says we now have 56 subscribers on Many Happy Returns channel. Thank you. I really appreciate that. You didn't have to. I really appreciate that. Thank you very much. So if I hit refresh here, wow, exciting. It is like the old days when my mum was the only subscriber to my channel. Here we go. Hit refresh. Is it refreshing? Control R. Here we go. 58 subscribers. Yes. Thank you. I appreciate that. So, yeah, we are finally getting there, but it's taking a while. And the stats are abysmal. So, that was quite exciting to see it all from scratch again. And quite scary when you create your channel, because you're worried about getting it wrong and getting the feeds wrong. So, yeah, that was exciting. So how are we doing for time? We're just about at time. I think we'll do one more question. We've got a super chat, so I'll answer that one. It's in Swiss francs, so thank you, Lippy BK. Your thoughts, NL, Chile, ENIC, too good to be true. So let's have a look. It's not something I'm familiar with, but I will have a look. Yeah. So let's have a look at it in Stockopedia just to see the kind of overview. The ticker is ENIC. ENIC. Move my face down a bit. So this one, stock rank again, 75. Pretty close to what it was for the other stock we looked at. And quality 59. Value 97. So this one's trading very cheaply at the moment. And momentum 40. So obviously this one's a bit of a contrarian play. So how does it get qualified? Yeah, because they do classify these stocks according to these stock ranks. I think this one would be kind of a recovery play, but it hasn't started to turn around. Didn't qualify for any screens, but certainly it's cheap. I'm just slightly worried about the quality aspect of it. So what's their definition of quality? So it depends on things like profitability, cash flow, margins, bankruptcy risk, volatility. So let's have a look at the things like leverage. Do we have leverage for this thing? Yeah, so bankruptcy risk pretty low. Oh no, close to distress. So slightly between cautious and distress. So there's a reasonable bankruptcy risk. And the gearing is pretty high at 58%. Maybe that's typical for this sector, which I'm not familiar with. Sales growth pretty good, which is good to see. Let's see what the margins are like. Margin, operating margin, 26%, so that's not too bad. Maybe that's not competitive with the rest of the companies in its sector. It has been quite volatile. And if we look at the earnings growth, always good. Yeah, so very volatile. Yeah, so look at that earnings growth. 2022 was great, but presumably off a low base. So it went from 94 Chilean pesos, million Chilean pesos probably, to 423, then 347, then 442. And the estimate for this year is 175, then 112, so it's heading in the wrong direction. So that's not good to see. That's unfortunate. So very volatile earnings. So that would worry me. So it's a Chile-based electricity utility company, and it generates, transmits, and distributes electricity. But yeah, I'm slightly concerned about the earnings volatility. So yeah, this is probably one I'd avoid until the momentum starts to pick up. And I'm slightly concerned about the quality and the default risk there. So yeah, I'll probably avoid it. Certainly wouldn't be on my list. Anyway, look, let's end it there. Thank you all for joining us. Don't forget, like, subscribe, have a look at Many Happy Returns on YouTube and listen to it there. And yeah, we've got a membership, pensioncraft.com/membership. If you want to join our community, we've got a new chat application which has our entire chat history going back to 2017. So there's quite a compendium of information which we've been sharing since then. In the early days, it was me and 2 other people, so not so much information. But now there's a huge information exchange. You can see that Spider fund, the new MSCI Acqui fund, well, not new, but newly cheap. That was mentioned on that channel, and that's how I was aware of it. In fact, a lot of the stuff that goes on, I'm aware of because of our chat channel and our community, which have a like mind. You know, they're interested in the same things which I'm interested in. Low cost, diversified investing, fund portfolio stuff as well. We do discuss single stocks. There is even a bit of crypto discussion, although not a lot recently, obviously. So yeah, do join our community, join the conversation. Our fees are very low. We haven't raised them with inflation, so I think it's £16 a month. So I think quite a reasonable membership fee for what you get, which is members only videos, the trackers, and we've also got the chat application with all of that juicy history, which is now never lost. Anyway, thank you all for joining us, and yeah, we'll speak again next time.